The interest rate on your mortgage, your car loan, your savings account, and your credit card are all controlled by the same place. One institution, the Federal Reserve, quietly pulls the strings behind nearly every financial product you use. And understanding how it works changes the way you see every dollar you earn, save, and invest. If you've been following this channel, you already know how interest rates work. You know what compound interest does inside a savings account, and you know what a rate hike means for your monthly mortgage payment. What we haven't answered yet is who decides. Who walks into a room and determines that your savings account now pays 5% instead of 0.5%? Who makes the call that borrowing money for a house suddenly costs twice as much as it did 2 years ago? A single institution makes those calls, and the way it operates is genuinely fascinating, not in a tinfoil hat way, but in a way where the machine turns out to be more elegant and more powerful than you ever realized. So let's open it up. On December 23, 1913, President Woodrow Wilson signed the Federal Reserve Act into law, and the part most people get wrong right out of the gate is what kind of institution it created. The Fed is not a government agency, and it's not a private bank either. It's something entirely unique, a hybrid, and it has 2 layers. The first layer is the Board of Governors, a federal body based in Washington, D.C. with 7 governors, each nominated by the president, confirmed by the Senate, and serving staggered 14-year terms that are intentionally designed to span multiple presidential administrations. From those sitting governors, the chair is selected for a 4-year renewable term, and the current chair is Jerome Powell, whose term expires May 15, 2026. 12 regional Federal Reserve banks make up the second layer, spread across the country in Boston, New York, Philadelphia, Cleveland, Richmond, Atlanta, Chicago, St. Louis, Minneapolis, Kansas City, Dallas, and San Francisco. Member commercial banks technically own stock in these regional banks, but this isn't normal stock. They can't sell it, they can't trade it, the dividend is fixed by statute, and it confers none of the rights you'd associate with owning equity in a company. The Fed describes itself as independent within the government, not independent of government. Congress can change the Federal Reserve Act. The chair testifies before Congress twice a year, and the system is audited. But here's the critical piece. Monetary policy decisions, the rate decisions that affect your wallet, do not require approval from the president or Congress. What surprises most people is the funding. The Fed is self-funded, not paid for by tax dollars. It earns its own revenue, primarily from interest on the securities it holds, and it actually sends its profits back to the U.S. Treasury. Between 2012 and 2021, over $800 billion flowed from the Fed to the Treasury. We'll come back to how it earns that money, because it's central to understanding the whole system. The reason the Fed was created in the first place tells you a lot about why it's structured this way. Before 1913, the United States stood as the only major financial power without a central bank. And when financial panics hit, which happened often, no institution existed to stabilize the system. During the Panic of 1907, it took one private citizen, the financier J.P. Morgan, to personally organize bailouts and stop the bleeding. A senator from Rhode Island named Nelson Aldrich led a commission to study the problem, and in 1910, a small group met secretly on Jekyll Island, Georgia, to draft a proposal. That meeting is real, historically documented, and yes, it did happen. The plan that came out of Jekyll Island was actually rejected, though. Representative Carter Glass and Senator Robert Owen crafted the Federal Reserve Act that eventually passed through public congressional hearings, with Wilson insisting on government oversight. The conspiracy version skips the most important part. The final product was built in the open, debated on the floor, and passed by elected majorities. You now have this powerful, independent institution sitting at the center of the financial system, and the question becomes what it's actually supposed to do. Congress gave the Fed 2 jobs, known as the dual mandate: maximum employment and stable prices. The Humphrey-Hawkins Act of 1978 formalized this arrangement, named for Senator Hubert Humphrey and Representative Augustus Hawkins. Stable prices in practice means a specific number, 2% inflation per year. Chair Ben Bernanke officially adopted that target in January 2012, and the Fed measures it using something called the PCE Price Index, which stands for Personal Consumption Expenditures, rather than the CPI number you usually see in headlines. PCE has a broader scope and updates its weighting more frequently to reflect how people actually shift their spending. Maximum employment doesn't pin itself to a fixed number. It's not 4% unemployment or 3%. The Fed treats it as a moving target based on labor force participation, wage growth, job openings, and a range of indicators. And this is where you start to see why Fed decisions are so difficult, because those two goals can directly conflict with each other. When inflation runs high, the Fed's main tool is raising interest rates, but raising rates slows the economy, which can push unemployment up. So the Fed is constantly balancing fight inflation at the cost of jobs or protect jobs at the risk of letting prices run. Jerome Powell addressed this tension head-on in his Jackson Hole speech on August 26, 2022, acknowledging that higher rates and slower growth would, in his words, bring some pain to households and businesses, but that failing to restore price stability would mean far greater pain. Markets dropped roughly 3% that day. Wall Street got the message. Let's get into the mechanics of how the Fed actually exercises its power. The primary tool is the federal funds rate, the interest rate at which banks lend their reserve balances to each other overnight. It's an interbank rate that you and I never see directly, but it drives everything. The Fed doesn't dictate this rate. It sets a target range and then uses a set of tools to steer the actual market rate into that range, and the current target sits at 3.5 to 3.75%. Today's main steering tool is something called interest on reserve balances, or IORB, which is the rate the Fed pays banks on the reserves they park at the Fed overnight. Think about that for a second. If a bank can earn 3.6% risk-free by leaving money at the Fed overnight, it's not going to lend that money to another bank for anything less. IORB effectively sets a floor under the market rate. For non-bank institutions like money market funds, the overnight reverse repo facility, or ONRP, serves the same floor-setting purpose for a different set of players. On the ceiling side, there's the discount window, the rate at which the Fed lends directly to banks. If banks can borrow from the Fed at a known rate, they won't pay more than that in the open market. All three tools work together to keep the actual overnight rate, called the effective federal funds rate, pinned inside the target range. It's a corridor system, elegant, quiet, and extraordinarily powerful. Now here's where it connects to you. When the Fed moves its target range, it doesn't directly change your mortgage rate or your credit card APR, but it sets off a chain reaction that reaches every financial product you touch. Start with the prime rate, which typically equals the federal funds rate plus 3 percentage points. Most variable rate financial products, including credit cards, home equity lines of credit, and adjustable rate mortgages, are pegged to the prime rate. When the Fed hikes, your credit card APR resets within 1 to 2 billing cycles, and you feel it fast. Savings accounts work the same way in reverse. When the Fed raised rates from near zero in 2022 to over 5% by mid-2023, high-yield savings accounts went from paying almost nothing to offering 4 to 5%, because banks could suddenly afford to pay you more when they were earning more from the Fed. Mortgages move a little differently because the 30-year fixed mortgage tracks the 10-year Treasury yield, not the Fed funds rate directly, but the Fed heavily influences Treasury yields through its rate decisions and its bond purchases. During the pandemic, the 30-year fixed rate hit a record low of 2.65% in January 2021. After the hiking cycle, that number peaked at 7.79% in October 2023, the highest level since 2000. Let me put that in real terms. On a $400,000 mortgage, the difference between a 3.85% rate and an 8% rate comes out to roughly $1,265 more per month in principal and interest. Same house, same borrower, same loan amount. The only thing that changed was a decision made inside a conference room at the Federal Reserve. Stock markets respond too, though less mechanically. Higher rates compress equity valuations because future cash flows are worth less in today's dollars, and they raise borrowing costs for companies. Research from Stanford found that unconventional Fed policies between 2010 and 2018 drove half of the 10 largest quarterly stock rallies and sell-offs. When people say the Fed controls your money, this is what they mean. Not in some shadowy conspiratorial sense, but in a structural, mechanical, verifiable sense. The rate they set in that room touches every dollar in the system. This is the part where most explanations go off the rails. So let's be precise about it. The Fed does not print physical money. Paper currency is printed by the Bureau of Engraving and Printing, a completely separate agency under the Treasury Department with facilities in Washington, D.C. and Fort Worth, Texas. Coins come from the U.S. Mint. The Fed orders currency from the BEP each year, but it doesn't operate the presses. What the Fed actually creates is bank reserves, and it does it by typing numbers into a ledger. When the Fed wants to inject money into the financial system, it buys Treasury securities from primary dealers, the major financial institutions authorized to trade directly with the Fed. It credits the selling bank's reserve account with new dollars that didn't exist before, dollars created by the transaction itself. That is open market operations, the most fundamental tool in central banking. Quantitative easing takes this process and scales it up enormously. When the 2008 crisis hit, and the Fed had already cut rates to zero, it couldn't cut any further, so it started buying massive quantities of bonds to push down long-term interest rates and flood the system with liquidity. The numbers are staggering. QE1 launched in November 2008 and purchased roughly $1.7 trillion in agency mortgage-backed securities, agency debt, and long-term treasuries. Another $600 billion arrived through QE2 in 2010 and 2011. QE3, starting September 2012, ran open-ended at $85 billion per month before being tapered down. And then came COVID. Starting in March 2020, the Fed purchased approximately $4.6 trillion in securities. The balance sheet, the total value of assets the Fed holds, went from about $4.2 trillion in February 2020 to a peak of $8.97 trillion by April 2022. For perspective, that balance sheet sat at around $870 billion before the 2008 crisis. Ben Bernanke, who chaired the Fed through the financial crisis, captured the confusion around all of this perfectly. On 60 Minutes in March 2009, when asked if the Fed was printing money, he answered, "Well, effectively." A year and a half later on the same show, his answer was different. One myth that's out there is that what we're doing is printing money. We're not printing money. That sounds like a contradiction, but it's actually a technical distinction. QE expands the monetary base, meaning bank reserves, but not physical currency in circulation. Whether those reserves become real money that people spend depends entirely on whether banks actually lend them out. That nuance matters, and it's the one that script-level explanations almost always miss. Every one of these decisions gets made by a single committee, the Federal Open Market Committee, or FOMC. 12 people vote. 7 of the 12 are the Board of Governors. The president of the New York Fed always holds a vote and serves as the committee's vice chair. 4 remaining votes rotate annually among the other 11 regional bank presidents, though all 12 presidents attend every meeting and participate in the discussion. 8 scheduled meetings happen each year, and after each one, the committee releases a statement at exactly 2 p.m. Eastern. The chair holds a press conference, something that only started in 2011 under Bernanke and was expanded to every meeting under Powell. 4 times a year, in March, June, September, and December, the committee publishes the summary of economic projections and the dot plot. Each participant anonymously places a dot representing where they think the federal funds rate should be at the end of the current year, the next few years, and the longer run. It's become one of the most closely watched documents in finance. The Beige Book also comes out 8 times a year, 2 weeks before each meeting, compiling anecdotal economic reports from all 12 districts. Think of it as the Fed's field intelligence. Dissent is allowed and recorded, and when a voting member disagrees with a decision, it's noted in the official statement. About 500 dissents have been recorded since 1936. At the most recent meeting, on April 29, 2026, the vote split 8-4. The first 4 dissent meeting since October 1992, which tells you something about how complicated the current environment has become. Let's see all of this working together in real time because the COVID response is the clearest example of the full cycle. On March 3, 2020, the Fed made an emergency rate cut of 0.5 percentage point, the first emergency cut since 2008, with COVID spreading and markets falling. 12 days later, on a Sunday, March 15th, they cut again by a full percentage point, dropping the target range all the way to 0, while simultaneously eliminating reserve requirements, restarting QE, and beginning purchases of $500 billion in treasuries and $200 billion in mortgage-backed securities. 1 week after that, they made those purchases unlimited. April 9, 2020, brought another announcement, up to $2.3 trillion in additional lending through the Main Street Lending Program for mid-sized businesses, the Municipal Liquidity Facility for state and local governments, and the revival of facilities first created during the 2008 crisis. 4 months is all it took for the balance sheet to go from $4.2 trillion to roughly $7 trillion. This wasn't a slow policy adjustment. This was a central bank deploying every tool it had at maximum speed. For context, during the 2008 crisis, the Fed had cut rates over the course of 15 months, from 5.25% in September 2007 to 0 by December 2008. In 2020, they went from 1.5% to 0 in 12 days. And then the other side arrived. By mid-2021, inflation was rising. Supply chains were broken, demand was surging, and all that liquidity was doing exactly what liquidity does. CPI reached 9.1% year over year in June 2022, the highest in 40 years. The Fed's response was the most aggressive tightening cycle in 4 decades. 11 consecutive rate hikes between March 2022 and July 2023 raised the rate from 0 to 5.25 to 5.5, 525 basis points total. 4 of those hikes were 75 basis point jumps, each one the largest single increase since 1994. That's the full cycle. Emergency stimulus, then an inflation spike, then aggressive tightening, then the slow process of easing back down. That's the machine working. Here's the big picture. Every topic we've covered on this channel, how savings accounts compound, how mortgages are priced, how inflation erodes your purchasing power, how the stock market reacts to economic conditions, all of it flows through this one institution. The Fed is the engine room, and now you've seen inside it. You know it's not a government agency, and it's not a private bank, but a unique hybrid that's self-funded, independent within the government, and accountable to Congress. You know it's 2 jobs, maximum employment and stable prices, and you know those jobs sometimes fight each other. You know the federal funds rate is the primary lever, and you know exactly how a decision in that room ripples out to your mortgage, your credit card, your savings account, and the stock market. You know how the Fed creates money, not by printing, but by crediting bank reserves through bond purchases. And you've seen what it looks like when the Fed deploys everything at once. None of this is abstract. Every rate decision the FOMC makes changes how much it costs you to borrow, how much you earn on your savings, and how much your investments are worth. Understanding the Fed doesn't just make you more informed. It helps you see why the financial world moves the way it does. The next time you hear the Fed held rates steady or the Fed cut by 25 basis points, you won't just hear a headline. You'll understand exactly what it means, who decided it, and how it's about to reach your wallet. That's the system. Now you see it.